welcome to Biztech's Inside Trading Show. It's a show all about trading. Every week we discuss what trading is all about and the required habits to be a successful trader. We also share trading ideas and themes to help you make money. Now, as always, with me is my co-host, Phan Vee Leung, founder and CIO of TrackRecord Asia. Vee, welcome to the show.
Hey, Brian, let's talk about trading.
Yeah, now for the first thing, as always, we talk about trading habits, Vee. And today we want to explore the topic of concentration risk and how we should avoid having stocks that are dependent on one outcome. Now, Vee, what does this mean? Tell us about this and how do we avoid the pitfalls?
Okay, so we spoke about not having too much risk, right? Having the correct sizing of risk before. And of course, we gave some guidelines in previous episodes. And then now it's a question that comes out, right? If you are allocating to different stocks, then does it mean that you are diversified, or does it mean that you have just one big trade that is expressed in different ways, right? So you have to look at the circumstances or the outcomes that are required for your stocks or whatever instrument you're trading. We say stocks for simplicity. That is what idea, what theme is that that your investment is expressing. So if, for example, if you are long REITs, which is real estate investment trust, all across Asia, in Singapore, Malaysia, everywhere else, and you're long real estate in real life, you basically have just one trade, right? It's real estate, right?
Okay.
The concentration risk, right? So you have to explore, have a think about what your investments are, what outcomes, what environments, what circumstances is required for your investments to outperform. And of course, if you have an investment that outperforms in all circumstances, all environments, then you found the holy grail, right? But it tends to be not that case, right? It tends to be most of them are dependent on a few outcomes, right? For example, what we've seen is that one of the primary drivers of markets is the US Federal Reserve policy, right? When they raise interest rates, regardless of what companies you have, what stocks you have, what investments you have, they come down, right? Except for energy companies, right? Oil companies were raking it in because of different circumstances, because of the war, because of commodities inflation and such circumstances. So it's always good to have a think through the trades that you have, although they may seem to be separate trades, but they could all just be expressing one idea. So I've seen in my professional trading career, as well as my contact with retail traders as well. For example, I've come across people who are just bullish dollars and they are long dollar across the board. They're long dollar against the yen, against the euro, against the Sing dollar, against anything that they can think of. They're just clicking and they're just buying dollars against it. But it all expresses one trade, right? Which is long dollars, right? So it's imperative whether you're an FX trader, a stock trader, or even a commodities trader, or just a global macro trader, you trade across all asset classes, to understand what is the main key risk that your portfolio is carrying, right? So you do not want to have concentrated risk. You do not have one single event or two or just a set of circumstances that's going to put your portfolio under pressure to such an extent that you cannot come back in the weeks and months ahead, right? You don't want to be suffer crippling losses, is what I mean. You want to say.
And Vee, this is exactly what happens with amateur traders who go in and do day trading and they do commodities trading on their own for the first time. They basically have this concentration risk and they don't diversify their portfolios.
Yes, exactly. And they all have various trades that express the same idea. And in times of crisis, especially in times of when the market is under stress, correlation between different asset classes goes up to a very high level, right? We tend to say it goes to 1, where everything moves in the same way regardless of what you have on. So you have to think about extreme cases to understand your concentration risk. You have to think about extreme cases where, as we've seen in the past, whether be it a war, a terrorist attack, or just for example, a bank failure, what it does to your portfolio in the shorter term as well as the longer term. Yeah.
Now, on that note, then we move on to trading ideas. And this week, we want to start about talking about something that's not talked about in the media. It's commodities. Well, we normally talk about gold and silver and oil, but today we want to talk about rice and sugar, because what's happened very interestingly in the last couple of weeks is the price of rice and sugar has gone up. V, what's your thoughts on this?
I think, of course, I'm not an expert in this, but looking from the charts, it looks like a very strong breakout to the upside, especially on the sugar charts that I'm looking at. And of course, it's a commodity, it's a soft commodity, and it's affected by weather, by seasonal factors as well. So I'm not an expert, but for trading purposes, for speculation purposes, you can easily just turn to futures. And of course, as always, you must have an understanding of where you're going to exit before you want to go in, right? Of course, have a look at the charts. I think it's quite clear that there's a breakout pattern, and obviously it's a very volatile market, but I think it will have repercussions not just on just the price of sugar itself. I think it's a sign that because we are looking at global macro trading, it is a sign that maybe inflation is not quite over yet. If we are seeing price pressures on the essentials that we have for our food and other ingredients as well. Yeah.
Now, V, then let's move on to something that we're more familiar with, banks and technology. Now, I want to start with tech first, because recall V, in the last show, we discussed Microsoft with relation to AI and how that's a stock with broad-based tech revenues around cloud, around AI, around their traditional subscription businesses in their productivity software and so forth. Now, Microsoft's earnings for the quarter have just come in, and the earnings came in well above expectations. So that's something, also the same thing, Google or Alphabet also came in at above expectations. Your thoughts on this, V?
Well, yeah, it's great. I think well done. You pointed out Microsoft is going to be one of the main beneficiaries of the boom in ChatGPT. But of course, the latest earnings that we have do not have that yet factored in. So that's why it's extremely positive on that front. In such an environment where everybody is looking to predict a recession and talking about layoff across the board, we saw very strong earnings as well as revenue growth from Microsoft. And I think in the months ahead, we are going to see more of this ChatGPT AI tech driving more revenue sources for them as well. So I think, as we've pointed out before, AI is going to be a big thing. If Microsoft is doing well without the AI driving driving the revenue streams, is going to go do extremely well in the months ahead. So I think you're right. Yes, we should get involved.
Now, then on the flip side, then we've had an event where the banks have been battered overnight. What are your thoughts on the banking stock play and all the jitters that still exist around the banking sector in the US?
Well, so I think first off, just a bit of a recap. In March, we saw a few US banks failing, and CSFB in Europe having to be taken over by UBS, and that was the start of a mini panic, right? But that was soon arrested because the governments came in, guaranteed the deposits beyond the insured amounts, and also the US Federal Reserve opened a window for lending to banks with collateral that is above market value, right? We're lending them above market value for the collaterals that they have, which is underwater. But that doesn't solve the problem that they have in the first place, which is that they have assets that are underwater, right? So these assets are basically loans and bonds. Bonds are basically just loans to governments or other quasi-government entities, right? So basically, essentially, in layman terms, they have lent money at very low interest rates when interest rates was below 1%, and now it's above 4%. And because of that, their assets are now impaired. It's underwater. but they're not mark to market. Means they just don't mark to market on the books, but everybody knows that there are losses. But and they are funding these assets. They are borrowing to pay for these assets, right? And they are borrowing from depositors. It's the whole banking business, right? They're borrowing from depositors. And because interest rates have gone up from 0% to 4.75% in the US, they now need to pay a more competitive interest rates to get depositors to give them the money, to put the money with them. But these banks, these regional banks, they are still paying below 1%, most of them. And because of the mini banking crisis, most of the consumers, most of the depositors in the US, they have woken up to the fact that why am I lending these banks, which may fail at any time, below 1% when I can get 3-4% from money market funds, 4% from Apple Bank, which is just launched in conjunction with Goldman Sachs. So why would you do that, right? So that's there's no answer to that, and the answer is just take your money out. So we have seen in the recent First Republic Bank earnings, their report, they have said that they have lost a total of more than $70 billion of deficits from their $170 billion of deficit. So they're now at $100 billion. They've lost $70 billion. That's more than 40%. And taking out the $30 billion, which is put there by JP Morgan and other big banks as a measure to stabilize that panic, that would have meant consumers have taken out, or businesses and individuals have taken out more than $100 billion from the bank. And they had only 170 billion to begin with in deficits. So that's the problem, right? Because of that, markets are starting to be worried again. But the whole problem is that they have lent out the money at very low interest rates, and now they're borrowing at very high interest rates if they want to be competitive. And they want to continue borrowing at low interest rates so that they don't suffer losses. No one's going to lend that money, right? If you won't, the depositors are waking up to the fact. So that's the problem. So how can that be solved? I don't think there's a real solution to this. It's because of risk management that is not rigorous enough to realize that this would be a problem as interest rates rose aggressively. So we'll see this continue to be hounding the markets in the days and weeks ahead until the government or policymakers do something about this. So is it possible that more banks will fail? There's always a possibility, and that's why markets are worried, right? But of course, I think the regulators are aware of this, the policymakers are aware of this. They'll try again their best to stem this panic, but I think it will require more measures and more commitment, right? So I believe that, of course, many people in positions of authority have said that this is not a banking crisis, but that's how it all begins, right? It's always not a banking crisis until it is, right?
So then caution is the order of the day, really.
Yes, but of course, this is very isolated to the banking sector at the moment. And I think because of that, there will be opportunities in other asset classes when the panic comes, or when the mini panics comes, where people just tend to migrate to cash for safety, right? So I think there will be many opportunities that lies ahead for us.
Now, V, on that note, thanks for coming on the show. And that's it for this week's Inside Trading Show. We've been speaking to Phan Vee Leung, founder and CIO of TrackRecord Asia, on Biztech's Inside Trading Show. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.